China holds $3.2 trillion in United States dollar assets. That's more than the $2.9 trillion gross domestic product of the United Kingdom in 2023. It's larger than the combined market value of Apple at $2.85 trillion and Tesla at $570 billion, according to November 2024 filings. For years, people online warned that China can crash the United States economy by dumping these holdings overnight. One massive sell-off, and the United States financial system supposedly collapses. The idea accelerates every time geopolitical tension increases. Here's what nobody tells you. If China ever tried to dump its dollars, the sequence does not start in Washington. The first economy to collapse wouldn't be the United States. The data shows a faster, deeper failure inside China's own financial architecture. The moment Beijing orders liquidation, reserve valuations fall, capital outflows surge, and internal liquidity fractures. Not later. Immediately. This is the structural reality analysts track. It would be China because the system was built like a financial bear trap that snaps shut on the attacker first. The next question is simple. Why is the mechanism designed this way? This isn't a story about China preparing a dollar-based strike against the United States. This is a system-level constraint. Two major powers operate inside the same financial structure, with no viable exit. China doesn't hold dollars for strategic intimidation. It holds them because the global reserve architecture eliminates every alternative. The scale of exposure becomes clear once the underlying architecture is quantified. According to the United States Treasury's TIC report from December 2024, China holds $786.4 billion in Treasury securities under direct attribution. This figure dominates public discussion because it is visible and recurring, yet it represents only the portion China allows to appear on record. It is a disclosure number, not an exposure number. A substantial share of China's Treasury position resides inside custodial reserve structures. Euroclear, listed under Belgium, reported $237.9 billion in treasuries as of October 2024. Analysts across JP Morgan, Barclays, and ING estimate that 63% to 71% of that figure, between $150.8 billion and $169.3 billion, belongs to China through the State Administration of Foreign Exchange. Custodial placement avoids political signaling and allows reserve adjustments without triggering algorithmic trading or market panic. With direct and custodial positions combined, China's verified exposure already exceeds $950 billion, and that is before incorporating sovereign wealth channels. Sovereign wealth portfolios expand exposure further. The China Investment Corporation, with $1.3 trillion in assets in its 2023 report, holds 38% or $494 billion in dollar-denominated instruments. Parallel safe-linked offshore vehicles across Hong Kong, Singapore, and the Cayman Islands add another $192.6 billion. These allocations are not optional. They function as liquidity buffers that anchor China's banking and currency systems. These positions extend China's exposure across United States credit channels. Federal Reserve data from September 2024 attributes $226.7 billion in agency securities and $184.4 billion corporate bonds to Chinese central bank and state bank portfolios. These instruments provide yield differentials and duration hedging but carry higher price sensitivity than treasuries. When spreads widen, these portfolios absorb accelerated losses. China's exposure also includes dollar liabilities. According to Bank for International Settlements filings from June 2024, Chinese state banks hold $811.5 billion in offshore dollar deposits, and Chinese corporations maintain $326.9 billion in outstanding dollar bonds through offshore subsidiaries. These liabilities require continuous refinancing in dollar markets. creating structural reliance on United States liquidity. The consolidated calculation is straightforward. $786.4 billion in direct treasuries, $150.8 billion in custodial treasuries, $494 billion in sovereign wealth dollar assets, $411.1 billion in agency and corporate securities, $1,138.4 billion in dollar deposits and corporate liabilities. Total exposure, $3,095.1 billion, consistent with multi-institution assessments of $3,200 billion, adjusted for reporting lag. Here is what this means. China's dollar position is not a reserve allocation. It is a multi-channel dependency embedded into its currency framework, banking system, sovereign wealth operations, and external trade structure. China is supporting the dollar system while remaining structurally locked inside it. The scale of exposure exists because it was built gradually through deliberate policy over decades. The mechanism emerged in the early 1990s when China aligned its growth strategy with export expansion. Foreign buyers settled transactions almost entirely in United States dollars due to international invoicing standards and commodity pricing conventions. By 1995, Ministry of Commerce data shows that 72% of China's external trade receipts were dollar-denominated. Dollar inflows exceeded domestic absorption capacity, embedding China inside the dollar system from the outset. As exports expanded, exchange rate intervention became unavoidable. To prevent yuan appreciation, the People's Bank of China purchased incoming dollars and issued yuan in return, generating large reserve balances that required placement in highly liquid, stable assets. United States Treasuries were the only market deep enough to absorb these flows. By 2001, China held $166 billion in treasuries. By 2004, the total exceeded $496 billion. Intervention produced reserves, and reserves moved into dollar assets. No alternative market could take inflows of this magnitude without distortion. A feedback loop followed. Export activity produced dollar inflows. Stabilization required absorbing those inflows. Reserve accumulation required deeper participation in United States debt markets. The cycle operated continuously from 1998 to 2013, with peak monthly reserve growth exceeding $40 billion. What began as an exchange rate tool became a structural engine supporting currency management and external asset allocation. By 2008, reserve accumulation hardened into formal policy. The global financial crisis reinforced the incentives. Federal Reserve liquidity operations made United States Treasuries the only asset class capable of absorbing expanding Chinese reserves. Safe data indicates reserves reached $3,087 billion by 2010, with roughly 65% held in dollars. The reserves maintained the yuan's valuation band, supported domestic credit, and projected external stability. The mechanism evolved into a macro-financial foundation. Dependence deepened when domestic institutions aligned with the reserve framework. State banks expanded dollar loan books for importers, commodity firms, and overseas contractors. Offshore subsidiaries borrowed in dollars to exploit lower global yields. By 2015, Chinese banks held more than $800 billion in offshore dollar assets, and corporations carried $250 billion in dollar liabilities. These positions required ongoing access to dollar markets, which required confidence supported by large, stable reserves. Here is what the data confirms. Export growth created dollar inflows. Exchange rate management required absorbing them. Reserve accumulation required large-scale United States asset purchases. Domestic banks and corporations internalized the dollar structure. Each step reinforced the next, until reversal carried destabilizing consequences. The result is structural dependence embedded across China's monetary system, credit architecture, and external financing channels. That dependence is not incidental, it is foundational. The scale of dependence makes the hypothetical unavoidable to evaluate. The scenario is direct. Beijing initiates an accelerated liquidation of its dollar assets, with no signaling, no phased divestment, and no stabilizing measures. It is the scenario frequently circulated in political rhetoric and online commentary. The mechanism is rigid, governed by market architecture, and the consequences unfold in sequential layers. The first layer is immediate market shock. Treasury yields react within minutes because the market is built on the assumption of steady foreign demand. Even a small liquidation from a multi-trillion-dollar holder forces yields higher. Primary dealers detect irregular flows. High-frequency trading systems register stress. Bid-ask spreads widen and liquidity thins. The yield curve steepens sharply as the market faces asymmetric supply with no equivalent demand. Prices fall because no institution can absorb the volume without repricing. The United States funding curve adjusts violently. The second layer is secondary price collapse. Falling Treasury prices trigger margin calls across leveraged portfolios. Risk parity funds, pension systems, insurers, and sovereign investors. Forced selling begins and accelerates the decline. Exchange-traded funds widen discounts. Money market funds hit internal thresholds. Volatility indices spike. Equities fall because valuations rely on discount rates tied to Treasury yields. Capital exits emerging markets. Currency volatility spreads across Asia, Africa, and Latin America. Institutions holding United States duration are forced into rapid risk reassessment. The correction becomes a cascade, not a cycle. The third layer is transmission into the real economy. Treasury yields anchor rates for mortgages, auto loans, corporate credit, municipal borrowing, and commercial paper. When yields spike, financing costs surge, mortgage rates climb. Corporate refinancing becomes restrictive. Investment projects pause. Consumer spending slows. Because the United States economy is deeply interest rate sensitive, financial shock converts into economic contraction quickly. The fourth layer is banking sector strain. Banks hold treasuries as high-quality liquid assets. When valuations drop, unrealized losses expand, and capital ratios compress. Funding markets tighten and internal liquidity buffers shrink. Smaller institutions face immediate pressure. Larger institutions restrict lending to preserve capital. What begins as a market shock becomes a credit contraction. Even moderate price declines erode capital buffers. A disorderly decline compounds the effect sharply. The fifth layer is Federal Reserve intervention. Treasuries underpin global collateral systems, interbank settlement, and dollar funding. The Federal Reserve cannot allow the market to destabilize. Intervention becomes automatic. Large-scale asset purchases, balance sheet expansion, and emergency liquidity facilities. Money market windows reopen. Primary dealers receive direct support. These actions halt the downward spiral, but do not resolve the underlying disruption. They merely change its form. The sixth layer is the reversal effect. Intervention stabilizes Treasury prices but weakens confidence in the dollar. Expanding the Federal Reserve balance sheet pressures external perceptions of currency stability. Foreign holders diversify into euros, yen, or gold. Offshore funding markets react to uncertainty. Dollar volatility increases. Swap spreads widen. Capital shifts toward alternative safe haven assets. The paradox is clear. Stabilizing the bond market destabilizes the currency market during a disorderly liquidation. The seventh layer is inflation and currency distortion. A weaker dollar raises import costs. Oil, food, and industrial inputs rise in price because global commodities are dollar-priced. Businesses pass costs on to consumers. Inflation accelerates, while the economy slows, a stagflation pattern similar to the 1970s supply shock period. The Federal Reserve faces a conflict: raise rates to contain inflation or maintain liquidity to protect funding markets. Both cannot be done simultaneously. The eighth layer is systemic deterioration. Prolonged volatility reduces institutional confidence. Pension funds alter allocation schedules. Insurers revise long-term liability assumptions. Corporations delay investment. Households increase caution. Political discourse shifts toward crisis framing. Treasury instruments, normally viewed as risk-free, are reassessed for geopolitical vulnerability. Collateral-dependent infrastructures, repo markets, clearinghouses, interbank settlement experience strain. The system moves toward recession and elevated political tension. Here is what this means. A disorderly liquidation produces market shock, forced selling, economic contraction, banking stress, emergency Federal Reserve action, currency instability, inflation pressure, and institutional deterioration. Each layer reflects pre-existing structures. None are speculative. These outcomes align with how modern financial systems transmit stress. The scenario also exposes a deeper assumption. Global stability depends on major reserve holders behaving predictably. That predictability is not enforced legally. It is enforced by mutual self-interest. The architecture is built for continuity, not confrontation. When continuity breaks, every linked system experiences pressure. Credit markets, settlement networks, commodity flows, and institutional risk models. When the largest external holder initiates disruption, the pattern is unavoidable. Market shock, asset repricing, liquidity contraction, intervention, currency volatility, international spillovers, institutional instability. The system permits no alternative sequence because the architecture permits no alternative reactions. This is the version that goes viral on social media, but it's missing the second half of the picture. Except the moment China dumps dollars, China collapses faster than the United States does. The mechanism is immediate and structural. Any major reserve holder attempting a disorderly exit destroys its own balance sheet before inflicting meaningful external damage. China's exposure is measured in trillions, so valuation sensitivity reacts instantly to aggressive selling. Pressure does not move outward first. It hits internally. The mathematics confirm this. Assume China unloads 5 to 10% of its total dollar exposure. With multi-trillion-dollar holdings, that equals $150 to $300 billion. A sale of that magnitude forces Treasury yields higher and prices lower. Even a 2% price decline wipes out tens of billions in value. A 5% decline erodes more than $100 billion. China loses more on what it still holds than it gains from what it sells. Every dollar sold reduces the value of the remaining position. Liquidation amplifies loss. The first crisis layer is reserve compression. China's reserves anchor monetary stability. A rapid valuation drop destabilizes internal liquidity expectations. Policymakers must either deploy more reserves to defend the yuan shrinking reserves further, or allow appreciation and harm exports. Both choices intensify internal pressure. The second layer is yuan appreciation. Selling dollars strengthens the yuan because it removes dollar demand. A stronger yuan makes exports uncompetitive. Factories face reduced orders, margins contract, and external demand shifts to lower-cost regions. This effect is immediate and severe. The third layer is manufacturing contraction. Tens of millions of export-linked jobs face pressure as production slows, supply chains weaken, regional employment drops, and domestic demand contracts. China's labor base absorbs the shock before the United States feels measurable impact. The fourth layer is banking stress. State-owned banks carry substantial dollar assets and liabilities. When global funding tightens, refinancing becomes difficult, liquidity mismatches appear, and regulatory buffers compress. Offshore stress transfers quickly onto domestic balance sheets. The fifth layer is accelerated capital flight. Shrinking reserves, a strengthening yuan, and manufacturing weakness signal instability. Even under capital controls, households and corporations move funds outward. This further drains reserves and amplifies volatility. The sixth layer is internal political risk. Employment pressure, weakened exports, and rising outflows strain local governments and increase social tension. Any mechanism that reduces stability is treated as a direct threat to political legitimacy. A disorderly liquidation triggers all such mechanisms at once. The sequence is unavoidable. China faces reserve losses, currency instability, export contraction, banking stress, outflows, and political strain before the United States enters recession. The architecture ensures the attacker absorbs the damage first. The asymmetry is straightforward. Liquidating 10% destroys the value of the 90% retained. Appreciation destroys exports. Export contraction destroys manufacturing. Manufacturing decline destroys employment. Employment decline destabilizes internal politics. Each step accelerates the next. This exposes the flaw in treating liquidation as a geopolitical weapon. The weapon fires inward. China loses reserves, competitiveness, liquidity, and stability long before the United States experiences systemic harm. This outcome is embedded in the reserve architecture itself. A disorderly liquidation weakens China immediately, and the United States only afterward. The collapse begins in Beijing, not Washington. China loses reserves, loses exports, and loses stability all before the United States enters recession. This is why the dollar system is a trap. The attacker bleeds out first. China understands that a disorderly liquidation would trigger internal collapse, so its actions focus on controlled, incremental reduction of dollar exposure while preserving system stability. The structure leaves only two viable strategies, both far smaller than the multi-trillion-dollar exposure they attempt to offset. Diversification into non-dollar assets and expansion of yuan-based trade channels. Neither alters the underlying dependence in the near term. Diversification operates through accumulation of non-dollar reserves. Gold is the central component because it carries no counterparty risk and strengthens balance sheet credibility. Public disclosures from the People's Bank of China show reserves rising from under 1,000 tons to above 2,000 tons over the past decade, equal to several $100 billion in stored value. Additional components include euro-denominated sovereign bonds, commodity-linked instruments, and limited allocations to the yen and pound. The impact remains modest. Even aggressive accumulation replaces only a fraction of China's multi-trillion-dollar reserve base. Gold markets cannot absorb hundreds of billions without distortion. Euro area sovereign markets lack the depth and liquidity of treasuries. Commodity positions introduce volatility unacceptable for primary reserves. Diversification limits marginal exposure, but does not meaningfully reduce the existing stock. The data is explicit. Gold strengthens optics, euros broaden exposure, and commodities hedge volatility. But none replicate the liquidity or collateral functionality of the dollar system. The diversification strategy slows additional dollar accumulation rather than unwinding structural dependence. The second strategy is expanding yuan-based trade and payment channels. Belt and Road loans issued in yuan create long-term external demand, and the cross-border interbank payment system provides a messaging alternative to SWIFT. The objective is transactional autonomy. Settle trade without passing through dollar channels. Progress is measurable but small. The yuan share of global payments has risen but remains low. Yuan-denominated Belt and Road lending has increased but is still minor compared to global dollar credit. International borrowers continue to prefer dollars because global invoicing, commodities trade, derivatives markets, and hedging systems are dollar-anchored. The dollar remains the global accounting and risk management baseline. The limitation is structural. For the yuan to displace the dollar in trade, counterparties must accept exposure to China's regulatory regime and capital controls. Most avoid that exposure because they require convertibility, open capital mobility, and deep hedging instruments. China cannot liberalize its capital account without risking destabilizing outflows, and it cannot maintain strict controls while expanding global yuan adoption at scale. The contradiction blocks rapid progress. The mechanism shows the boundary clearly. Yuan-based trade increases influence but cannot absorb flows measured in trillions. SIPS reduces reliance on SWIFT messaging but does not replace dollar-denominated settlement infrastructure. Belt and Road lending creates isolated yuan pockets but not global reserve adoption. The scale needed to materially offset China's dollar exposure is measured in trillions. The actual expansion is measured in tens of billions. Both strategies operate in parallel, but remain slow relative to the underlying risk. Diversification reduces marginal concentration, but cannot replace the liquidity profile of dollar reserves. Yuan expansion creates alternatives, but not substitutes. China is adjusting peripheral elements of the system, not the foundation. The structural imbalance ensures that dependence remains dominant, even with sustained diversification and incremental yuan internationalization. China began systematic diversification in the late 2009s, attempting to shift portions of its reserves away from dollar instruments without destabilizing its currency regime or its banking structure. The effort has now been underway for more than 15 years. The results are measurable, but the pace is slow relative to the scale of exposure. The first metric is the yuan share of global payments. According to data from international settlement networks, the yuan accounts for roughly 3 to 4% of global transactions. Despite China representing more than 15% of global output, the second metric is gold as a proportion of total reserves. Even after a decade of steady accumulation, gold remains below 10% of China's total reserve composition when measured against multi-trillion-dollar holdings. Both indicators show progress, but both reveal the same constraint. Diversification moves in increments, while exposure exists in magnitudes. Here is what the data indicates. At the current rate, China is only 15 to 20% of the way out of the system it aims to reduce reliance on. The gap between diversification progress and structural dependence remains large. Even sustained gold accumulation replaces only a marginal portion of total reserves each year. Yuan internationalization increases visibility, but does not meaningfully shift global settlement patterns, which remain anchored to the dollar through commodity pricing, trade invoicing, and collateral requirements. The math is linear on China's side and exponential on the system side. Meanwhile, counterparty deterioration accelerates. United States fiscal deficits continue rising. Global dollar demand remains entrenched. China's export base still depends on dollar-denominated global purchasing power. The system evolves more slowly than Beijing's exit strategy. This is the race. China is trying to exit a system faster than the system itself slows. The timeline does not work. The structure creates a bilateral dependence neither side can unwind without absorbing damage. The United States relies on China's continued demand for Treasury securities because large foreign purchases suppress yields, stabilize federal financing costs, and maintain the collateral base of the global dollar system. A meaningful reduction in China's participation raises borrowing costs, tightens financial conditions, and forces heavier reliance on domestic buyers and Federal Reserve balance sheet expansion. This dependence is embedded in fiscal projections, auction mechanics, and global liquidity models. China's dependence functions in reverse, but with equal severity. Its export-driven economy requires sustained United States consumption. The United States is the largest end market for Chinese manufactured goods, and declines in demand directly pressure China's industrial output, employment levels, and provincial revenue. Tens of millions of workers rely on export-linked industries. The flow of goods to the United States is not optional. It is foundational to China's labor and fiscal stability. The structural difference from past geopolitical rivals is critical. Unlike the Soviet Union, China is integrated into America's financial bloodstream. It exports goods, earns dollars, recycles those dollars into United States debt instruments, and uses the resulting reserves to stabilize its currency and banking system. Each link reinforces the next. Breaking one destabilizes the entire sequence. The Soviet Union operated outside the dollar regime. China operates inside it. The data is clear. The United States cannot lose China's treasury demand without destabilizing funding markets. And China cannot lose United States consumer demand without destabilizing its industrial base. Both systems rely on the other's continued participation. Neither can detach without self-inflicted harm. This is the most sophisticated financial standoff in modern economic history. For more than 2 decades, the arrangement functioned as a mutually beneficial system. China expanded its export base, scaled its manufacturing capacity, and generated employment for tens of millions of workers. The United States gained access to low-cost consumer goods, suppressed inflation through globalized supply chains, and sustained lower interest rates, because foreign reserve accumulation supported Treasury demand. The relationship delivered measurable economic advantages to both sides, and those advantages reinforced the structure that produced them. Here is what the data shows. The benefits created dependence. China relied on uninterrupted access to United States consumers, and the United States relied on uninterrupted participation from China in its debt markets. Each side optimized for short-term gains without reducing long-term exposure. The economic integration deepened. The structural risk increased. The architecture became rigid. The shift occurred when the benefits began to decline, but the dependencies persisted. China's growth slowed. United States supply chain resilience concerns increased. Trade tensions narrowed the margin of advantage. Yet the reserve structure, the trade flows, and the financial linkages remained intact. The system no longer produces the same gains, but it still imposes the same constraints. The result is a lose-lose configuration, built from what was once a win-win cycle. The possible trajectories consolidate into 3 systems-level scenarios shaped by structural constraints, not policy preference. The first is an orderly adjustment. China continues gradual reserve diversification, incremental yuan settlement expansion, and controlled participation in United States debt markets. Reserve rebalancing remains slow. Gold accumulation remains modest, and yuan usage grows regionally rather than globally. The United States absorbs this shift through domestic demand and long-horizon foreign holders, adjusting portfolios over time. Market stability is preserved because neither side forces a break. Volatility appears, but disruption remains limited. The probability is roughly 50%, reflecting strong incentives on both sides to avoid destabilization and the absence of any alternative global architecture capable of absorbing multi-trillion-dollar flows. The second scenario is a crisis flashpoint. A geopolitical shock, internal instability, or policy miscalculation triggers accelerated selling of dollar assets or aggressive capital control actions by China. Markets treat the signal as a liquidity shock. Treasury yields jump. The Federal Reserve intervenes with emergency balance sheet expansion and global swap line activation. The yuan becomes volatile as China chooses between reserve deployment or depreciation to contain outflows. Global markets deleverage simultaneously. Commodity prices swing, emerging market currencies weaken, trade flows contract. This scenario carries a probability of approximately 35% given current geopolitical tension, rising United States fiscal pressure, and China's ongoing economic slowdown. The third scenario is systemic break. This occurs if the dollar-centered reserve structure fragments, or if China's reserves erode to the point where currency stability fails. The trigger may be geopolitical fracture, debt market dislocation beyond central bank containment, or domestic crisis forcing excessive reserve deployment. The consequences include recession in both economies, fragmentation of global trade, emergence of regional currency blocks, and weakening of collateral systems built around treasuries. The probability is roughly 15%. The analysis is clear. All scenarios impose costs, none produce a clean resolution, and the most likely outcome is the slow, grinding adjustment. This isn't about cheering for one side. It's about understanding that when a reserve structure comes under stress, the impact reaches individuals through the channels that transmit every major financial shock: asset volatility, currency swings, and inflation pressure. When treasury markets destabilize, valuations shift across equities, bonds, real estate, and commodities. When the dollar experiences turbulence, the cost of imported goods changes, purchasing power fluctuates, and global pricing adjusts. When inflation accelerates, The real value of savings, wages, and fixed income assets declines. These effects do not require a crisis. They occur whenever the underlying architecture strains. Here is what that means for you. Exposure concentrated in instruments tied directly to the dollar-based system carries sensitivity to policy cycles, geopolitical events, and liquidity conditions. Reducing vulnerability requires holding assets that retain value independently of the reserve structure. Real assets such as gold and land maintain utility regardless of monetary volatility. Income-producing assets, dividend-generating equities, rental properties, and cash flow instruments provide returns that offset price instability. Diversified currency exposure, including positions in non-dollar currencies or global exchange-traded funds, reduces reliance on a single monetary system and spreads risk across multiple jurisdictions. The objective is not speculation. It is insulation. Hold things that aren't trapped inside this system. If this shifted how you see the United States-China financial relationship, hit subscribe and stay with the channel. Every week we break down global economic systems with the level of detail most outlets avoid, focusing on how the underlying mechanisms actually function. Turn on notifications so you don't miss the next episode, where we examine what happens if the United States debt market loses its final stabilizing layer, and the system is forced to operate without its traditional safety net.